Welcome back to the Deep Dive. Ready to explore something pretty powerful in the world of investing?
Absolutely. I think today's topic is one that a lot of people can benefit from.
I totally agree. We're going to be diving into the world of SIP investments. And to make things even more interesting, we'll be looking at it through the lens of market events over the last 30 years. Specifically, we'll be using the HDFC FlexiCap Fund and the BSE Sensex as examples.
It's going to be like a financial time machine.
Exactly. So buckle up. Now, I know some of you might hear SIP and think, another acronym, another thing I have to figure out.
Yeah, that's understandable.
But trust me, by the end of this, you'll see why SIP is considered like a superpower for building long-term wealth.
Definitely. Especially when you see it in action through these historical market events.
Exactly. We've got some fascinating data going back decades, all focused on the Indian stock market.
Yeah. Should be pretty eye-opening to see how things played out.
All right, let's set the stage.
Well,
Imagine it's 1995. The BSE Sensex is at a low point of 2,922.
wow, even thinking back to 95. So much has changed.
For sure. Could you have predicted back then what the next 30 years would hold?
Honestly, I don't think anyone could have.
I probably would have been tempted to hide my money under the mattress.
Uh-huh. I get it.
But for this deep dive, let's say on January 1st, 1995, you decided to put $10,000 every month into that HDFC FlexiCap fund.
Okay, interesting. So we're talking about a regular, disciplined investment through an SIP.
Yep, that's the scenario we're going to explore. Now, I know we've mentioned SIP a couple of times, but let's break it down. What exactly is an SIP?
So SIP stands for Systematic Investment Plan. And essentially, it's a strategy where you invest a fixed amount of money at regular intervals into a chosen mutual fund.
Okay, so instead of trying to time the market and figure out the best moments to buy or sell, you're just consistently investing.
Exactly. It takes the guesswork out of it. And there's a real beauty to this approach. It's all about something called rupee cost averaging.
Rupee cost averaging. Sounds kind of complicated. What's the deal with that?
It's actually simpler than it sounds. Think of it like this. You're buying, say, apples every week. Sometimes the price is high, sometimes it's low, right?
Yeah, that makes sense.
With rupee cost averaging, you're basically buying those apples regardless of the price. So some weeks you'll get fewer apples for your money, some weeks you'll get more.
Okay, I see where you're going with this.
So over time, the average cost of those apples evens out. And it's the same concept with an SIP. When the market is down, your fixed investment amount buys you more units of the fund. And when the market's up, you're buying fewer units.
So it's kind of like you're automatically buying low and selling high without even having to think about it.
Exactly. That's the magic of rupee cost averaging. It really smooths out your investment journey in the long run. Takes the emotion out of the equation.
I like the sound of that. Okay, so let's get back to our 1995 scenario. Our hypothetical SIP is chugging along. We're putting in that $10,000 a month, and then boom, 1997 hits. The Asian currency crisis.
Ooh, that was a major event. Definitely shook up global markets.
So what happened to our SIP during that crisis?
Well, this is where you start to see the real power of SESI. While the BSE Sensex took a hit, our SIP just kept going. Remember, it's a steady, consistent investment regardless of what the market is doing, so it just continued to accumulate units month after month, even amidst all that turmoil.
Okay, so our SIP basically weathered the storm.
Exactly. Now, let's fast forward a bit to the year 2000. The dot-com bubble bursts. And before the market has even had a chance to fully recover, we're hit with another major shock, the 9/11 attacks in 2001.
Those are definitely some back-to-back blows. Did our SIP survive that?
Absolutely. This is where that rupee cost averaging we talked about really comes into play. See, when the market dropped during these events, our hypothetical investor was actually buying more units at a lower price. While it might felt a bit scary at the time, they were essentially getting a discount on their investment.
So even when the world feels like it's falling apart, our SIP is calmly going about its business, accumulating those units.
Exactly. It's that long-term vision at play. Now let's jump ahead to 2008, the global financial crisis. This one really hit hard.
Yeah, this one wasn't just a blip on the radar. The impact was felt globally.
Absolutely. And it was a huge test for any investment strategy. But even though the value of our SEP would have dipped along with the market, it never stopped accumulating units. Remember, that consistent investment is what makes all the difference.
So even in a crisis of that magnitude, our SIP held its course.
It did. It's amazing to see its resilience, isn't it?
It really is. But wait, we're not done with the market turmoil just yet.
Oh, are we talking about the pandemic?
Yep. 2020 rolls around, and the world is hit with another massive event. How did RSIP manage to navigate the COVID-19 pandemic?
This is where that long-term perspective we keep talking about is so crucial. While the market initially plummeted, our SIP kept buying units, even at those lower prices. And as markets eventually recovered, those units purchased during the dip contributed significantly to the overall growth of the investment.
It sounds like our SIP was stocking up on bargains during all the chaos.
You could say that. And it demonstrates how a disciplined, long-term strategy like SIP can help you navigate even the most unexpected market events. But the ups and downs didn't end there, did they?
Nope. The world just loves to keep us on our toes.
That's for sure.
So, more recently, in 2022 and 2023, we had the Russia-Ukraine war and the ripple effects of those interest rate hikes.
Yeah, it definitely created some volatility in the markets.
So even with these more recent challenges, our hypothetical SIP with those steady monthly investments continued on its journey, picking up units even through the dips. We've seen it face down so much. But what about the actual numbers? What does 30 years of this disciplined SIP investment actually look like?
That's the big reveal. Let's fast forward to July 31st, 2024, and see what our 10,000 monthly SIP in the HDFC FlexiCap Fund achieved, all against the backdrop of the BSE Sensex.
I'm on the edge of my seat. Let's see if our resilient SIP has really lived up to the hype.
All right, drumroll please. Remember back in 1995 when even a single crore seemed like an unimaginable fortune?
Oh yeah. Back then it felt like winning the lottery.
Well, hold on to your hats because as of July 31st, 2024, that steady 10,000 monthly SIP in the HDFC FlexiCap Fund has grown to a remarkable 20.42 crore.
Wait, 20.42 crore? Seriously?
Seriously, it's a testament to the power of consistency and long-term thinking. It's incredible what can happen when you just stay the course.
It's mind-blowing. Like our little SIP sprout turned into this massive financial oak tree.
It really did. And to add some perspective, the BSE Sensex over that same period delivered a KGR of 15.89%, which is impressive on its own, right?
Definitely.
But the HDFC FlexiCap Fund, powered by our disciplined SEP, achieved a KGR of 21.67%. So you see, that difference, it might not seem huge at first glance, but compounded over 3 decades.
Whoa. It creates a massive difference.
It really does. Significant wealth.
Wow. Okay, so our SIP didn't just survive those market storms we talked about. It actually thrived.
Exactly. And it goes to show you don't need to be some Wall Street whiz to build wealth.
Right. You just need discipline and a solid strategy. So what were the key factors at play here that contributed to this phenomenal growth?
Well, 2 words. Compounding.
Ah, yes. Compounding. That magical word everyone in finance loves.
It's kind of a big deal. And rupee cost averaging.
Got it. So compounding. That's a snowball effect where your returns start generating their own returns.
Precisely. It's like this financial chain reaction. And since SIP involves regular investments, it really harnesses that power of compounding.
Okay, I'm picturing it like we're building a snowman. You add a little bit of snow every month, and over time, it transforms into this giant snow fort.
I like that analogy.
And what about the rupee cost averaging? We talk about how it helps during those market dips. But how does it contribute to that long-term growth?
Well, think of it as a balancing act. When the market's up, your fixed SIP amount buys fewer units.
Right, which can feel a little frustrating at the time, I imagine.
It can, but it actually prevents you from overpaying when those prices are inflated. Then, when the market dips, you're accumulating more units at a lower price. Over time, that buy low, sell high cycle, driven by consistent investing,
It averages out your cost.
exactly, and it enhances your overall returns.
So it's not just about surviving the downturns. It's about using them to your advantage. It seems like SIP takes the whole timing the market thing out of the equation.
You got it. It's about time in the market.
Makes sense. And the longer you invested, the more powerful those benefits become.
Exactly, which is why SIP is so well suited for those long-term goals like retirement planning or funding a child's education.
Makes perfect sense. Now, we focus primarily on the HDFC FlexiCap Fund for this deep dive, right?
They have. It provides a great example.
But does the success of an SIP really hinge on that specific fund you choose?
That's a great question. While the basic principles of SIP remain the same, the fund you choose can definitely influence the outcome. Different funds have different investment strategies, risk profiles, performance track records, all that.
Okay, so it's not like a one-size-fits-all kind of thing.
It's not. You really need to do your research and pick a fund that aligns with what you're looking for, your financial goals, risk tolerance, all of that.
Got it. So aside from choosing the right fund, What are some other really crucial things our listeners should keep in mind when they're considering SIP as a strategy?
Well, a few key points. First, SIP requires discipline and patience.
Yeah, you're in it for the long haul, right?
You are. It's a commitment. You're committing to those regular investments typically for several years. So there will be periods where the market dips and you might feel tempted to stop your SIP.
Oh, I can definitely see that happening.
But it's during those times that consistency is absolutely crucial.
It's like running a marathon. You've got to pace yourself, stay hydrated, and push through those moments when you just want to give up.
Exactly. Great analogy.
Okay, what else is important to remember?
Diversification.
Yes. Don't put all your eggs in one basket.
Exactly. Just like you wouldn't put all your money into one single fund. You want to spread it out across different asset classes, different fund categories. It helps reduce risk, and it enhances your portfolio's stability.
So it's like, instead of betting everything on one horse, you're spreading your bets across several horses in the race.
Exactly.
That makes a lot of sense. But what about those times when life throws a curveball and you need to access your money? Are there any downsides to the SIP approach that our listeners should be aware of?
That's a good point. While SIP offers many advantages, there are some things to consider.
Okay, good to know.
Most SIPs come with lock-in periods.
So you can't just dip in and out whenever you want.
Not really, no. It means you can't withdraw your investments before a certain time without getting hit with some penalties.
So there's a commitment involved.
There is. And while that rupee cost averaging helps to smooth out those market fluctuations, it's important to understand that in certain market conditions, like a really bullish market, a lump sum investment might actually yield higher returns compared to SIP.
So it's not a guaranteed outperformer in every single scenario.
It's not, no. There are always nuances to consider.
Makes sense.
And finally, it's super important to remember that past performance. It doesn't guarantee future results.
That old disclaimer.
It's important. While historical data can give us some insights, it's not a crystal ball.
Right. So even though our hypothetical SIP in the HDFC FlexiCap Fund did exceptionally well over the past 30 years.
Doesn't mean every SIP will follow the same path.
Exactly.
Investing always carries some level of risk. SIPs are no exception, so doing your research, understanding how much risk you're comfortable with, and maybe even talking to a financial advisor.
All super important steps before you jump into any investment.
Couldn't agree more.
This has been an incredibly insightful conversation. We've unpacked the nuts and bolts of SIP, traveled through time to see how it navigates those market ups and downs, and even touched on some potential downsides. But as we wrap up this deep dive, I have to ask, what's that final thought-provoking question you have for our listeners?
Knowing what you know now about the potential, the discipline required, and the nuances involved, what steps are you going to take to shape your financial future?
That's a powerful question to end on. It really makes you pause and think about what steps you can take to secure your financial future.
It does, doesn't it? And it's not about, making these huge, drastic changes overnight.
Right.
It's about starting somewhere. Taking those first steps, no matter how small.
Small steps lead to big changes. Okay?
Exactly. Even something as simple as starting a small SIP can set you on a path toward financial independence.
I like that. It reminds me of that saying, the best time to plant a tree was 20 years ago. The second best time is today.
That's a great one. And it really applies to investing, too. I mean, what we've explored today, using the HDFC FlexiCap Fund and the BSE Sensex as examples, shows us that starting early and staying consistent, it makes a world of difference.
And it busts that myth that you need a ton of money to get started. I mean, our hypothetical investors started with just $10,000 per month. Look what they achieved.
Exactly. It's all about time. Time is your greatest ally in the world of investing.
The more time your money has to grow, the more it can benefit from that compounding magic.
Exactly.
Okay, so as we wrap up this deep dive into the world of SIP investments, what are the key takeaways our listeners should remember?
First and foremost, SIP is not some get-rich-quick scheme. It's a disciplined, long-term strategy that takes patience and a commitment to those consistent investments.
Okay, so it's more like building a house, brick by brick, month after month, until you have a really solid foundation.
Love that analogy. That's exactly it. And secondly, rupee cost averaging. That's a powerful thing.
It really is.
It works in your favor, especially when the market's going up and down like a roller coaster. It helps you accumulate more units when prices are low, fewer units when they're high. It smooths out the ride.
Like a built-in shock absorber for your portfolio.
You got it. And while our deep dive focused on the Indian stock market, these SIP principles apply to various investment vehicles, mutual funds, ETFs, and so on.
And always remember, diversification is key. Don't put all your eggs in one basket.
Couldn't agree more. Spread out the risk, create a well-rounded portfolio.
Now, before everyone rushes off to start their SIP journey, what's that one crucial piece of advice you always emphasize?
Knowledge is power.
Yes.
Take the time to really understand the different investment options out there. What's your risk tolerance? What are your financial goals? Don't be afraid to seek guidance from a financial advisor.
It never hurts to have an expert in your corner.
Never hurts.
This deep dive was just a starting point. We've given you a map, but the journey, that's yours to take.
Exactly. And remember, the best investment you can make, it's in your own financial literacy. Keep learning, keep exploring, keep investing in yourself.
I love that. Well said. Until next time, everyone, happy investing.